Hi, my name's Jenny Brown and I work at Mortgage Finance Brokers. We wanted to record a video which would really kind of run through the basics of mortgages. So things like what is a mortgage, how much do I need to earn to get a mortgage, what sort of deposit do I need to be able to buy my own home. There's really kind of basic questions that actually are so very important for people, particularly those who are starting on their home buyer journey. So we hope you find this useful. A mortgage agreement in principle, which is sometimes referred to affectionately as a MIP, also a decision in principle or a DIP or even DIP, they're all the same thing, is it when you've gone to a lender and approached them formally and said that you would like to borrow some money from them via a mortgage. So at this point, what you're doing to the lender is saying, this is my situation, this is how much I earn, this is my background, this is my credit rating, this is my income, this is what I'm looking to do. And the lender will, broadly speaking, use a computer-based decisioning process these days to run some checks and come back and either say, yes, in principle, based on what you've told us, and we haven't verified any of this at this point, but based on what you've told us, we are prepared to lend you money, subject to essentially proving everything that you've said. So a mortgage agreement in principle is essentially a high-level application made to a lender where you've told them some information and they've come back and said, based on what you've told us, based on your credit rating, we would be happy to lend you this money. It's not a guaranteed offer of a loan by any stretch of the imagination. The reason these are important is that when you're looking to make an offer on a property that you're thinking about buying, having a mortgage in principle really shows that you are creditworthy, that you've investigated your ability to obtain finance, and insofar as you can check this and have some credibility when you're making an offer on a property, it really, really helps. In the mortgage industry, we love a bit of jargon, and one of the phrases or expressions you may have seen is LTV or loan to value. So just to explain to you for a moment what that actually means. So essentially the LTV is an expression as a percentage of how much you owe on the property versus the value of the property. So if we have a property which is worth £100,000 and you owe £75,000, then you would express that as a loan to value of 75%, i.e. I have a mortgage which is equivalent to 75% of the property's value. When we're looking at mortgages, lenders often base their pricing on different loan to values. So if someone has a loan to value of 80%, so they owe a mortgage of 80% against the property value, they're going to be seen as a higher risk borrower than someone who has a loan to value of 50%, for example, and therefore you'd expect to get slightly lower mortgage pricing. So essentially, the lower the loan to value, the more competitive the rate is going to be that you're going to get. In terms of being able to access the lowest mortgage interest rate, there's quite a few things that can influence the ability to get at the best rates. So the first thing is going to be loan to value. So the greater the equity in the property, the perceived lower risk of the application, and therefore the better the interest rate is going to be. Another thing that's really important is having a really good credit profile. So if you have some minor credit blips or even large credit blips, you're going to find that the mortgages are going to become more expensive. So try and keep your credit profiles as clean as you possibly can. The third thing is the kind of property you're looking to buy. So some lenders will be quite restrictive about lending on certain types of property. So if you imagine, I'm looking to buy a 3-bedroom semi-detached house, which is made of very standard construction, there aren't any lenders who are going to say no to that. But if you've got, for example, a studio flat above a off licence, then obviously that's going to be more nichey to get a mortgage on, because there's less people who are going to want to buy that kind of property. You couldn't squeeze a whole family into a studio flat, for example. So that might limit the number of lenders who would lend to you, and that could push up the pricing. So the property type does come into it. Another thing is really about your own sort of personal circumstances. So essentially, if you're looking to borrow a reasonable amount compared to your income, then you're going to find there's going to be an abundance of lenders who can consider lending to you. But if you're really looking to push up the amount you can borrow versus your income, then you're going to find there are fewer lenders who'll be willing to take you on. The fewer lenders there are, the less choice there is. Invariably, what that means is that actually the mortgage interest rate can become more expensive. Another thing which can influence which mortgage rates you can access is going to be your paperwork. So one of the things that's really, really important is making sure that you have everything ready and organised. So in terms of the kinds of paperwork that lenders are going to want to see, and this list is by no means exhaustive, but they're going to want to see proof of deposits. They're going to want to see the funds in an account in your name. And if it's just kind of dropped into your account, so for example, I don't know, your nan's giving you a gift of 50 grand, or wouldn't that be nice, but that kind of thing, they're going to want to understand where that money has come from, and actually they need to see a trail of where it's come from as well, and understand that it's actually legitimate funds, essentially. Another thing is payslips. So 3 months payslips and P60s are very, very standard requirements from lenders. If you're not employed, you're self-employed, they're going to ask for your last year's tax returns and tax year overviews. And if you're a company director, it could be they're going to want to see the last 2 years' accounts for your business as well. In terms of bank statements, 3 months personal bank statements, and what the lenders are looking at here is day-to-day account conduct. So have you been utilising an overdraft or going over your overdraft? Are there any payments going out for things which you may not have declared on the application form? So for example, loans, credit cards, any behaviours which are kind of worrisome for lenders. So for example, things like short-term loan companies like rate setters, or alternately betting payments as well. So they're kind of looking at behaviours. They're also going to want to make sure that the income they see coming into your bank account matches up with what's on your payslip. But I think in short, to get at the really good interest rates, the kind of fundamental things are going to be loan to value. So the greater the deposit as a percentage of the property value, the better the rate, good clean credit profile, and straightforward properties. For those of you who are wondering how much you need to be earning to be able to get a mortgage, it's a really difficult one to answer. So perhaps if I explain how lenders look at and underwrite mortgage applications, that will kind of give you a sense of how things work. So essentially what a lender's going to do is say, well, okay, you have an income of X amount of money, and that translates to a net monthly payment into your bank account of a lower figure once you've paid your tax and national insurance and pension deductions and all that kind of stuff. So you've got this net monthly figure coming into your bank account. How much of that is going to be left to put towards a mortgage? So then they're going to knock off things like loan payments, credit card payments, other essential payments. So for example, childcare, school fees, maintenance payments, if you have to make them, all that kind of stuff. So once they've gone through all the things that you're committed to spending, you then have a lower level of money left over again, which would be essentially free to put towards a mortgage. They also need to focus on the fact that you need to live. So they're going to use ONS data with regards to things like how much you're going to need to spend on food and lifestyle and essential bills like your council tax, insurance, that kind of stuff. And once we've taken away all of those things, there's a figure left over, which is the amount of money that, with everything else removed, that's what you've got left to put towards a mortgage. Then they do a backwards calculation. So if you've got this amount of money left to put towards a mortgage each month, what does that translate to in terms of actual amount you can borrow? So that's really how it works. Now, in terms of giving you kind of a set number, generally speaking, between 4 and 5 times your income is where these calculations tend to land. Now, it can be that for someone who has a really high level of income and no overheads whatsoever, you can maybe get even as far as 5.5 times your income. And for those of you with maybe more sort of normal or lower incomes, particularly if you've got a lot of overheads or expenses, you might find that actually lenders are capping you to more like 3.5 to 4 times your income. So it's not a straightforward one to answer. The best thing I can advise you to do is go and speak to a mortgage brokerage, preferably us, because what they can do is go through your finances, understand your situation with regards to your overheads, go through lots of lender calculators and figure out which lender is going to be able to give you the amount of money that you actually need. We often get asked how much deposit you're going to need to have to be able to get a mortgage. And the very short answer to that would be that the baseline level, the absolute minimum, is 5% of the purchase price of the property. However, please just keep in mind that it's a 5% deposit as a minimum, but the mortgage still needs to be affordable in terms of the lender's income calculations. So as an example, if you're buying a property for £100,000, you've got a 5% deposit, so you're putting in £5,000, you want to borrow 95,000. If you're only £10,000 a year, that mortgage is still not affordable to you, so the lender wouldn't lend to you. So it's not quite as binary as, well, I've got my 5% deposit, I can get a mortgage. The numbers still have to stack up in the background. The other thing just to say is that actually at 5% deposit, you really are at kind of the far end of the market in terms of what lenders allow. So you're going to be paying the highest level of interest rate because this is the greatest level of risk. It wouldn't take much in a falling property market for someone who's just bought a property and put in a 5% deposit to move into negative equity. So you would be regarded as the highest level of risk. So actually, the greater the deposit you can put in, the better the interest rate is going to be. But in short, 5% deposit is your absolute minimum. When you are thinking about buying a property, you are going to need about some potential costs that come up as part of the mortgage application process. Now, this list is not exhaustive, and actually it doesn't mean you necessarily end up paying any of these costs, but you might do, so it's worth being aware about them. And if you are looking into a mortgage or buying a property, I'd be asking the question about these fees as to whether they're going to be incurred. So first one is, when you're applying for a mortgage, lender application fee. Most lenders don't charge these, but some lenders do, so it's worth knowing about it. The fees tend to range from around £100 to around £400, and the payment that you're making here would be giving the lender some money to essentially underwrite your mortgage application. The risk here is that if you pay this fee and the lender subsequently declines your application, their argument is that they did try and underwrite the case, they've done what they said they were paid to do, the outcome may not be what you like, but they did do their side of the agreement, therefore that fee is not refundable. Now, like I say, this is kind of a minority of lenders charge this rather than the majority, but just to be aware of this. The second fee is a valuation fee. Now, this valuation fee, so as part of the mortgage application process, the lender's going to want to understand the property which they've been asked to lend on. So making sure that it's worth what you're paying for it, that actually there's nothing kind of untoward about the property, that it looks, to be in reasonable condition, it's not about to fall down, all that kind of stuff. And also understand that if the lender did have to take possession of the property because you hadn't made your payments, then actually they're going to be able to sell it on reasonably quickly for an amount of money that would be sufficient to cover any money owed to them. So the valuation fees, they vary significantly. The lower the property value, the lower the valuation fee. The further we go up property value range, the higher the valuation fee becomes. So it's a kind of varying figure. Now, not all lenders charge a valuation fee, and often actually in the homeowner space, the valuations come for free. The thing you need to know about these valuations, as an aside, is that actually the mortgage valuation is not for your benefit, it's for the lender's benefit. So the valuation is really designed, or the mortgage valuation is designed to say to the lender, yeah, it's worth what the property's been paid for. There's nothing obviously wrong with it. And if you did have to resell it, we think it would resell relatively quickly. If as a buyer, you want more guarantee than this, and even some recourse if anything got missed, then actually you'd need to look at a more involved survey. The next fee you need to think about that might be incurred is an arrangement fee. So an arrangement fee is something the lender charges you for arranging the mortgage for them. And these fees can vary hugely in pricing. It can start up with no fee, and they can end up at sort of 7, 8, 9% of the loan amount, and that would be very high, by the way. And there really is a kind of broad range in between the two. Now, here at MFB, what we will do is say to a client, look, if you're looking at a 5-year fixed rate, then what we can do is look at the overall cost. So your interest payments or your mortgage interest costs over a 5-year period plus the arrangement fee. And we'll do this repeatedly across many, many deals. And the deal which costs the least overall is the one that we would probably recommend to you. But it's worth just knowing about the arrangement fee. Now, the arrangement fee can be paid up front. Often people can add them onto the loan. Just know that you do still owe that money at the end, and you're going to be charged more often than not interest on it as well. Other fees to think about: stamp duty, legal fees. These are kind of the two big ones. So legal fees will vary depending on the nature of the transaction and also the size of the transaction. So, for example, when I say nature of the transaction, what I mean is that if you're buying a house, so it's a freehold, you will find the solicitor's cost cheaper than if you're buying a leasehold property where the lease has to be inspected. In terms of the other things that can affect legal costs, the higher the property value, the more expensive your legal fees are going to be. So just keep that in mind. And lastly, let's not forget about stamp duty. Stamp duty has been changing. There's lots of calculators available online, so you can figure out how much your stamp duty bill is likely to be as well. The mortgage process is often seen as a very mystical and complicated one, but actually when you look at the kind of stages the mortgage application process entails, it's really quite straightforward. There are really kind of, I suppose, 3 main stages. So the first one is mortgage decision in principle. The second one is underwriting, and the third one is mortgage offer. And I suppose then at the end we have completion as well. So let's go through those one by one. So mortgage decision in principle is where we would approach a lender on behalf of our client and say, this is Jenny, she lives at this address, she's got this date of birth, she earns this amount of money, she's got this amount of debt, these other ongoing commitments, she's looking to buy a property for X amount and would like to borrow this amount of money from you. How does this sound? Please go ahead and check her credit file and make sure it all looks okay. At this point, nothing that we've told the lender has been verified, so it's all just based on keying in headline information. So the lenders, and it's normally a computer-based decisioning process, the algorithm will kind of go through, do a search on me, check the numbers all make sense and that my credit profile is satisfactory. And on that basis, it comes up with a mortgage agreement in principle saying, yeah, based on what you've told us, we're prepared to lend Jenny X amount of money. That bit of paper is not binding for the lender. It doesn't guarantee me anything, but at least it tells me that on face value, at least, we're good to go. So the next stage of the application process is underwriting. So we've done our agreement in principle. Then what we need to do is essentially demonstrate or prove to the lender what we've told them. So Jenny earns X amount of money, here are her pay slips. Jenny is looking to borrow X amount of money and she's putting in this amount herself. Here's the proof of deposit. She's buying a property worth £150,000. They do a valuation to make sure that's the case. So there's all these things that go on backwards and forwards. Assuming all these things go through and they work out okay, the next stage happens, which is the mortgage offer. And that is where the lender issues a mortgage offer, which is binding, saying, we, XX Bank, are prepared to lend Jenny this amount of money on these terms. So this particular interest rate fixed for this period of time over this many years, whatever it is. At this point, if you're buying a house, what then happens is the whole process moves to solicitors. So then the solicitors will be working behind the scenes, trying to do all the things that are necessary to make sure that everyone's comfortable in terms of the purchase. So it's going to be making sure that you are buying a property which doesn't come with any kind of challenges or anything that's going to cost you a load of money or you're going to come unstuck with down the line. But also they're doing stuff for the lender as well. So making sure that for the lender's perspective, the property makes good security. Once everybody's happy, so you've got your mortgage offer, the solicitor's done all of their work, at that point you can move to completion. And if you are a home buyer, that means actually completing on the property, taking ownership of it. If you're remortgaging, it means that the mortgage would at that point transition from the existing lender to your new provider. Mortgage brokers are essentially people that sit between the mortgage borrower and the mortgage lender. Now, obviously, I'm going to be a massive advocate of mortgage brokers because I am one, but I think actually there's loads of great things that we do that maybe people don't realise. The first thing is, why do people actually use a mortgage broker? So the number one reason people come to us is A, to find the best interest rate, and B, if they can't place the mortgage or get the mortgage across the line with their own bank. So most people, when they are thinking about taking a mortgage, the first thing they do, they go to their own bank and ask them for a mortgage. And because you're only approaching one lender, it can often go horribly wrong. And at this point, people think, oh God, what am I going to do now? And they pick up the phone to a mortgage broker. So in terms of finding the best rate, we have access to all of the mortgage rates at our fingertips, nice and straightforward. Once we know about our clients, what that means we can do is marry up our client's situation with the best mortgage rate available. And so that means that the client ends up with the best deal for them based on their circumstances and requirements first time around. There's not lots of failed applications during the process. We make it really, really quick, really, really easy. The second thing that we do as a mortgage brokerage is we're going to be liaising with all parties of the transaction. So we're going to be dealing with your solicitors, the valuers, the mortgage lenders, the estate agents, and keeping everything kind of moving along. So that removes a huge amount of stress from you as a mortgage borrower. Now, we don't stop there at MFB. So what we do is actually continue to track things once you've completed. So we're going to be writing to you through your mortgage term, keeping in touch, making sure you're doing okay, and if you need anything from us. And then what we're going to be also doing is notifying you well in advance of your mortgage rate ending to let you know that's coming up, and opening the door for discussions about what we're going to do next to ensure that A, you don't end up paying the lender's standard variable rate because they're really expensive. And secondly, making sure that the next mortgage you take, whether it's with your existing lender or with a new lender, it's going to be the very best deal for you as well. So I think the key points are that mortgage brokers will make sure that you have a successful application, which will save you time, money, and also a lot of stress. They're going to make the whole process a lot more seamless, more less stressful, and they're going to ensure that actually buying a house or remortgaging your house is actually something that is very, very pain-free and, dare I say, almost enjoyable. And there you go. So look, I hope you found that useful, but if you have any questions, we'd absolutely love to hear from you. 0345 345 6788, or you can email us inquiry@mortgagefinancebrokers.co.uk, or there's lots of information on our website, lots of case studies and calculators, a rate finder, that kind of stuff. So loads of information which will be really helpful to you. And you can also contact us via a live chat system on our website as well. Thank you so much for watching.